This is just one of those episodes that I would just want to release as a quick reminder because I don't think a lot of folks have done this math that invest in multifamily real estate, and I don't think people really understand the impact that managing revenue has on an overall property's performance. We all understand we want to increase rents and reduce vacancy and maximize revenue, but oftentimes you haven't actually sat down and done the math on what that actually looks like. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to talk about how a very small increase in a property's vacancy rate actually creates a significantly outsized impact on a property's net free cash flow when you translate that increase in vacancy to how it impacts NOI and therefore net free cash flow. And the theme of this episode is that investors need to focus on increasing revenue because expenses are typically fixed, and increases in revenue typically drop straight to the bottom line and have an outsized impact on your net free cash flow. So let's get into it. All right. So as I mentioned in this episode, we're going to talk about why it is so critical to reduce vacancy, and upstream from reducing vacancy is increasing renewals, reducing turnover, maximizing rental rate when you are leasing units, because gross income is the most important component of a multifamily P&L to focus on, because the vast majority of expenses when operating a multifamily property are fixed. And I speak about this a lot in different episodes of the podcast, but property taxes are fixed. Insurance is typically fixed. Your contract services, cleaning the common areas, mowing the lawn, plowing in the winter, those are fixed. And when I say fixed, I mean that they don't depend or they don't fluctuate based on the rents that an investor charges or the percentage of occupancy at a property. Whether a property is 50% occupied or 100% occupied, insurance is going to be the same. Taxes are going to be the same. It's going to cost the same to mow the lawn, et cetera, right? And you can extrapolate throughout all the other expenses on a P&L. Now, lower occupancy does lead to slightly lower expenses in some other categories. For example, repairs and maintenance. If somebody's not in there using the appliances or living in a unit, your repairs and maintenance spend is going to be a little bit lower, or expenses are going to be a little bit lower. Same thing with the owner paid water or other utilities. But that said, the vast majority of your multifamily P&L is going to be fixed expenses, and therefore it's even more important that investors maximize income, because that income therefore typically drops straight to the bottom line at a very high percentage of that incremental income increase. So in this episode, I'm going to specifically focus on vacancy rate and that impact. And I posted an episode on this topic, I think it was maybe a year and a half ago now, but I want to post it as a refresh because the podcast has grown since then. And even for the folks who listened to it a year and a half ago when I released it, I think it's really important to share it again because of how critical this concept is. And what sparked me to share this and want to revisit this discussion and this topic is the conversation I had with Stacey Hampton in the episode that we released, I believe, 2 episodes ago. I believe that was episode 279. If you haven't listened to that episode, that is a literal must-listen episode. One of my favorite podcast episodes that I've recorded on this podcast because of how tactical and how specific that episode was in regards to discussing multifamily operations. But a part of that episode that we discussed was the true cost of turnover for multifamily investors in terms of the lost rent, lease-up cost, the cost to actually turn units, and what that actually does to a multifamily P&L, and why just turnover is the most important metric for investors to track. And as part of that conversation, or as part of that turnover cost, I should say, we talk about lost rent, right? In terms of the rent that we lose when the unit is vacant and we have to spend the time turning it and leasing it up, and how that actually impacts a multifamily P&L. So I want to share a quick example. I know I'm probably going to lose people who are listening to this in the gym or, in the car. I want to quickly run through some specific examples to paint a realistic scenario, and then I'm going to highlight it with percentages at the end that really drive this home. So straightforward example. Let's say we got a 100-unit building, $1,000 rents monthly. If we assume a 5% vacancy rate, this property collects $1,140K every year. Again, you can gloss over the numbers if you just want to wait until I get to the conclusion. Let's assume that we got $500K in operating expenses, which is a little less than a 50% expense ratio. We have an NOI of $640,000. Now we're just going to, for example's sake, assume that increases in the NOI just drop straight to the bottom line for ease of having this conversation. Not quite the case, but again, the vast majority of increases in collected revenue does drop straight to the bottom line. So that's just what we're going to assume just for sake of the conversation. If vacancy is reduced to 3%, revenue increases by 24,000. That's a 2% difference. NOI goes to 664. But what we're talking about here is a 2% change in vacancy results in a 3.68% increase in NOI. So almost a 2-to-1 impact, right? Which is how we start to view the importance of generating revenue in a multifamily property. We almost have a 2-to-1 impact. And this is assuming a fairly high expense ratio for a multifamily property of, mid 40s, high 40s. Now let's say we have fixed debt service at 320K annually, which is about a 2-to-1 debt service coverage ratio. Again, that's a really healthy debt service coverage ratio. The more leverage you use, the more amplified this example's become. And I'll touch on that here, but this is just, again, for example's sake. So if we got 320K in debt service, that extra 24K in NOI flows straight to free cash flow, which boosts free cash flow in a given year by 7.2 plus percent, 7.22%. That is a massive impact on net free cash flow that is distributable to you as an owner or to your investors. Now let's flip it the other way. If vacancy increases by 2% and we're collecting less revenue, right? If we have 7% vacancy instead of 5, again, I've done the math behind the scenes, that trickles down to a 7.78% decline in net free cash flow. That is a massive, massive impact, right? Think about that. That's huge. In a given year, that's making or breaking your deal, like really fundamentally speaking. And the more leverage you use, the more pronounced that shift is. This is assuming some moderate debt service because we've got a 2-to-1 coverage here in terms of our debt service and the property NOI. That's a really healthy debt service coverage ratio. If you're at a 1.25 at a 1.5, that then only increases on a percentage basis. So here's the big rule of thumb that I'm trying to communicate here. And this is the big, hey, if you're zoning out at the gym or in the car, like pay attention again. Helpful rule of thumb emerges here. A 1% change in vacancy typically leads downstream to a 4 to 6% change in your net free cash flow. So again, I'll say that again. 1% change in vacancy has a 4 to 6x effect, if not higher. If you use more leverage, if you're really using max leverage and you've got a 1.15, 1.2 debt service coverage, a number's probably going to be above a 6. So typically what you're seeing is anywhere from a 4 to 6x impact for every 1% change in collected revenue. And I'm just using vacancy as an example here. This is why it is so critical for multifamily investors to closely monitor their gross income at the property level and to reduce things like turnover, to increase things like lease renewals, to try to increase the average stay of a resident from 2 years to 3 to 4 years. And it helps you think about the balance between turning over units and trying to, pick up another 3 to 4% in rent. If you have to accept 30 days of vacancy to do that, 30 days of vacancy over the course of a year is 8% vacancy. 1 month of vacancy in a year is 8% vacancy. Do you want to take 8% vacancy to pick up 3%? Well, if you do that, you're going to have to own that resident with subsequent renewals for over 2 years to really account for that trade. And that's just the lost rent. That's not counting turnover expenses, lease up costs, etc. So again, that's really the big takeaway here is every 1% in vacancy has a 4 to 6x impact on net free cash flow. And you actually account for the change in NOI. And then downstream, after accounting for debt service, the impact in net free cash flow. So this is just one of those episodes that I would just want to release as a quick reminder because I don't think a lot of folks have done this math that invest in multifamily real estate. And I don't think people really understand the impact that managing revenue has on an overall property's performance. We all understand we want to increase rents and reduce vacancy and maximize revenue, but oftentimes you haven't actually sat down and done the math on what that actually looks like. So if you found this episode insightful or helpful, please leave the podcast a rating and review. Helps the show get noticed by more folks. And if you've learned anything on this podcast, I think it's a pretty light ask to request a quick little rating, whether it's iTunes or Spotify, in terms of where you're listening to this. But again, hope this was helpful, and I'll catch you guys on the next episode.